Can there be a bubble in something if it has no price? Joining us now is Allison. She's also a senior fellow at the Manhattan Institute. Good question. Can you? Is there?
I think it's the question of our time, really. So it's because so much capital is now going to markets where there is no price. But and I think this has actually been one of the things they argued was great about it is, prices can't collapse if there's no price at all.
Well, so what does a collapse look like, though, in this situation? I mean, just hypothetically, because, I mean, these guys will always make, folks in the private equity space, they'll always make this argument about not having to mark to market and that they have more flexibility and renegotiating things here. So if there is real trouble there or trouble afoot here, what does that look like?
Well, it's more of a slow bleed than a collapse with like a bubble that would say exists in public markets because, the LPs also just can't pull their money out like the way they can in public markets. So you don't just get everyone running for the hills and freaking out and sort of pulling all their money out and then you have this sort of overcorrection in prices.
Well, sorry, but on that point, because that's a really good point, and we've heard from a lot of LPs grumbling about this, how does that, though, affect the potential for new funding rounds and whenever those vintages, and they do get their money out, are they going to put that back into private equity or are they just going to say we're done with it and they're going to move on to something else?
I think that's where the damage happens. Is they just, especially pension funds who are sort of not sort of getting their money back now and are finding, they're struggling to pay benefits, is they just don't go to private equity at all. And in some ways, there's nothing wrong with private equity. I mean, maybe it got a little too big, but it does fulfill an important purpose in our economy. And that might be the overcorrection, is just like people get really scared of putting money in their asset class at all. And then we find a lot of companies that have become a lot more dependent on private financing over the years for a variety of reasons can't get financing.
So does that money, though, get weirded out by private equity but go to private credit instead?
It might, but I mean, private credit might get some of the same issues. I mean, I think people underestimate a lot of the risks with private credit. I mean, I think for years, a lot of us wondered where the low rate environment where bubbles were brewing, and it might have been largely in private markets. And I think what people don't appreciate sometimes with private credit is that, a lot of their loans are floating rate. So if rates don't go back down, then, they might have a lot of companies that struggle to refinance and they might see more defaults.
In the private equity world, though, has secondaries, I know secondaries have been around for a really long time, but I feel like they've grown so much in a short amount of time also. Has that helped stem bleeding?
Not yet, but I think that might be a symptom of the issue is that, there's reports of these zombie funds where people can't get their money out and they're having to sell on secondary markets and take a big discount. So, so far, we all read Matt Levine. It does seem like it's a fairly opaque market that's not functioning that well either. But if it gets big, then honestly, then is it really private equity anymore? Because then you do have a market price on these things.
Does Matt Levine get paid by the word? Because his columns are always so long. I mean, they're great, but they're always so long. And yours are very just short and sweet here.
I have a stricter word limit than he does.
Inquiring minds want to know. In all seriousness, though, but you mentioned this idea here, too, of floating rates, and I've heard this argument, too, particularly from the private equities firm's perspective, the idea that they will continue to profit off of this. But, of course, that kind of hobbles the company itself. And I do wonder if a crash or whatever we're going to call this, a slow bleed, if this does become a situation of liquidity drying up, the companies that are saddled with these loans can't do anything else to invest back in their business, and effectively they either tip under or at least sort of just kind of limp along.
Yeah, which, I don't know what's worse is if you just, like in public markets, like we have with the tech bubble, this crash, and then there's just this recession and, a lot of this sort of, this cleansing element of the economy, or if you'd get this slow bleed, because people will also lose jobs. I said if their employer can't get financing, and I think people underestimate how much more people are turning to private markets and not going public.
But we've heard from the Fed, for the first time in a long time, I forgot it was a few meetings ago, we actually saw this mentioned actually in the Fed statement. We saw this come up also in the recent bank asset test where they mentioned the role or the connection with private markets here. So it's clearly on the radar of regulators that this is an outsized influence right now in our economy, and no one seems to really know exactly how healthy it is.
Yeah, I think it always concerns regulators when a lot of money is going to a market they can't really measure or control or regulate. So, and rightly so. One thing I feel like we learned after the 1930s is it's a lot better for people to invest in things that are transparent and have a clear market price and are well regulated. Yeah.
That doesn't sound like our market today, does it?
It sounds like actually we've now decided that's all a bad thing.